Our next guest says to prevent another flash crash, regulators should prohibit the use of market orders on electronic exchanges. He's a finance professor at the University of Southern California's Marshall School of Business. He was an SEC chief economist as well and author of Trading and Exchanges, Market Microstructure for Practitioners. Larry Harris, fight on, a fellow USC Trojan.
Thank you. It's a pleasure to be here.
So first, tell me in your view, what happened? What caused the flash crash? We love these flash crash.
The flash crash. The flash crash had many causes.
Fat fingers, sketchy traders, what do you think?
But it really was a very simple story. What happened was that there was an excess of sell orders relative to the buy orders. It was a simple order imbalance. But it took place in an electronic environment where the computers that matched the buy orders to the sell orders didn't know that they were matching prices that were way below what any seller expected. And the reason why that happened is because the sellers used market orders instead of limited orders. And the market order instruction is to simply go out and get the best available price. When the best available price is very low, that's what they got.
And then you suggest the SEC should always require price limits for sell orders. So doesn't that shake up a system that's worked relatively well, pretty effectively, with the exception of last Thursday's glitch?
The system has worked very well, but it's a system that we inherited from when we used floor trading. Now, we're not about to go back to floor trading, and now we're in electronic trading, and it's important that traders trade appropriately in such systems. Not all other, but most other electronic systems throughout the world, and even some here in the United States, only accept limit orders. It's time that we do that for our equity markets as well.
Do you foresee another flash crash happening in the near future?
I don't think it's likely at all, and certainly would be impossible to happen if people were not allowed to submit market orders.
What about this idea? Former New York Stock Exchange Chairman Dick Grasso suggests simply that the circuit breakers at various exchanges should be set together so they work in tandem. Would that solve this problem? That
would also solve the problem, but it introduces other problems. Perhaps most notably, you would be stopping each stock separately according to its conditions. And what would then happen is that data vendors such as Bloomberg and others would then form an index to show how many stocks are stopped at any given moment during the course of the day. And if that barometer went, say, from 10% to 20 to 30%, people watching it might get panicked. And that would not be a good thing.
Larry, I got a question for you. It's Dominic Chu here. I mean, having been one of those guys, one of those traders, maybe not on the floor, but in my prior life here, I mean, market orders are a tool that I use, and I'm sure many traders use, on a consistent basis. Now, granted, there are times when the markets get disjointed, but is it really fair to basically characterize one tool in a toolbox, so to speak, as being a culprit when it pretty much works almost 90-some% of the time, and just, for a couple slivers here and there may have caused some panic?
Yes. Well, I hate to take away anything from any trader. The good news is that if you want to sell and you don't have a market order available to you, you simply place a limit order with a limit price of 0. That's identical to a market order. Likewise, if you want to buy and you can't use a market order, just set your limit buy at a price that's double or 5 times as high as the price you expect to pay, and you will effectively create a market order. So when we say that traders are not allowed to use market orders, there's no harm done, but we do put the trader responsible for the orders that they trade.
An interesting discussion. Larry Harris of USC School of Business, many, many thanks to you. And